Netflix, because even the world's biggest streaming giant isn't having the best day. From Wall Street pressure to disappointing content reviews and new regulatory concerns, there's a lot going on behind the scenes. Let's jump in. First up, Netflix just took a hit from JPMorgan, one of the biggest financial institutions in the world. The bank cut its price target for Netflix's stock, signaling lower expectations moving forward. Why is this a big deal? Because price target cuts don't happen unless analysts see warning signs ahead. And in this case, they're worried about a few things: subscriber growth leveling off, engagement numbers not keeping up with expectations, big competition pushing into Netflix's territory, and the idea that Netflix may be running out of easy ways to make more money from existing users. Basically, Wall Street is saying Netflix might be entering its maturity stage, and future growth could be slower than investors hoped. This has put pressure on the stock, and it adds uncertainty as we head into the next quarter. Next, let's talk content, because Netflix is taking heat in the media today. Their newest holiday movie, Champagne Problems, just dropped, and critics are not being kind. Major reviewers have called it mostly charmless, boring and repetitive, and part of Netflix's forgettable holiday lineup. While one bad movie isn't the end of the world, these reviews highlight a larger issue. Netflix is releasing more content than ever, but not all of it is winning audiences over, and today's reviews sparked renewed criticism about the platform's quality control. For a company that spends billions on original programming, bad press like this doesn't help. On the business side, Netflix is facing new antitrust worries connected to its industry ambitions. Lawmakers and media watchdogs are raising concerns about Netflix's influence, especially as the company explores potential partnerships or acquisitions. The argument goes like this: if Netflix keeps expanding its empire, it might end up controlling too much of the streaming landscape, reducing competition. Anytime politicians start mentioning the word monopoly, investors take notice. Regulatory pressure can slow down deals, block mergers, or force companies to change strategy. For Netflix, this adds another layer of uncertainty just as competition from Amazon, Disney, Apple, and others continues to heat up. There is also a smaller but still interesting headline making waves today. Netflix is removing Death to 2020, one of its own branded Netflix original titles. This caught people off guard because the whole point of an original is that it stays on the platform permanently. Removing it raises questions like, is Netflix changing how it handles its originals? Is licensing more complicated than people think? Are some Netflix originals not actually fully owned by Netflix? It's not a huge story on its own, but it adds to the narrative that Netflix's content strategy is shifting and not everyone likes the direction. So overall, Netflix is facing a mix of financial pressure, negative reviews, regulatory uncertainty, and brand-confusing content decisions. None of these issues are catastrophic alone, but together, they paint a picture of a company entering a more challenging and competitive phase. If you want more daily breakdowns like this, make sure to like, subscribe, and hit that notification bell. Thanks for watching.